Hello, my name is Anil Kumar Rambai Darkhala, and today I will be presenting my dissertation on analyzing how revenue and artificial intelligence technology adoption affects profit and profitability in UK's automotive sector. This project examines the financial performance of leading UK automotive companies and explores how revenue and AI adoption shape profitability. The UK automotive industry is a vital part of the economy, contributing over 60 billion pounds in turnover and employing around 780,000 people. However, the sector has faced challenges due to Brexit, COVID 19, supply chain disruptions, electrification, and rising digital transformation costs. Traditionally, firms assume that higher revenue means higher profitability, but in practice, this is not always true. Costs, regulations, and R&D spending often reduce margins. On the top of this, the growing adoption of artificial intelligence, while promising for efficiency, comes with heavy upfront costs. This creates uncertainty about its short term impact on profitability. The aim of my research was to analyze how revenue and artificial intelligence adoption affects profit and profitability in the UK's automotive sector. The main objectives are to examine the relationship between revenue and profits, to assess how revenue impacts profitability ratios like return on assets and return on equity, and to investigate how AI adoption influences profitability, and to identify financial trends and deviations across companies with different levels of AI adoption. My study focused on four major manufacturers operating in the UK. These are Jaguar Land Rover, Nissan UK, BMW Mini, and Toyota UK. The data covered a 10-year period from 2014 to 2023. I used audited annual reports, industry databases, and financial statements, concentrating only on manufacturing, not retailers or suppliers. I grounded the study in three main theories. The first one is financial performance theory, which links firm success to financial indicators. The second is resource based view, which suggests long term profitability comes from unique resources and capabilities, such as technology, like artificial intelligence, and you can say ADAS. And the last one is cost volume profit analysis, which shows how high fixed costs common in automotive manufacturing and can distort the revenue profit relationship. I adopted a quantitative secondary research approach where data collected from company reports and verified industry databases. Descriptive statistics were used to summarize financial trends. Correlation analysis explored relationship between variables, One way ANOVA compared across firms, regression analysis tested how revenue and AI adoption predict profitability indicators such as ROA and ROE. The software I used for statistical testing was SPSS by IBM. This is the data I have used. You can see the data, and this is the output of all the tests I have done. You can see the outputs. Now moving to next slide. The findings reveal some surprising results. Like revenue had a negative relationship with profitability ratios like ROA and ROE, and net income, however, was the strongest predictor of financial performance. This shows that revenue growth alone does not guarantee profitability, especially in capital intensive industries like automotive manufacturing. The adoption of AI showed a weak positive relationship with net income, but a negative relationship with ROA and ROE. This suggests that while AI investments may increase cost in short run, they hold long-term potential for competitiveness, supporting the resource-based view theory. Looking across the 2014 to 2023 period, there was a consistent decline in profitability ratios. This decline can be linked to external shocks like Brexit and the COVID 19 pandemic, as well as structural changes such as electrification and stricter regulatory compliance. When comparing across firms, Jaguar and Land Rover struggle with profits despite rising revenue due to warranty costs and especially with EV investments. Toyota and BMW managed steadier profitability thanks to lean operations and premium pricing, and Nissan's results were affected its mass market focus and sensitive to supply chain disruptions. This shows that business strategy heavily influence how revenue and AI adoption translate into profitability. My dissertation contribute to three areas of knowledge. First one is it highlights the paradox where higher revenues do not always improve profitability. It provides evidence on short-term costs but long-term potential of AI adoption. It adds a UK specific longitudinal perspective to the literature. For practice, the study suggests managers should focus more on efficiency and sustainable margins, not just revenue growth. Gradual AI adoption is advisable to balance cost with benefits. Policymakers should provide consistent regulations and targeted incentives to support innovation. In conclusion, my study shows that revenue alone is not reliable indicator of profitability. Profitability depends more on cost efficiency, strategic management, and long-term investment in technologies like artificial intelligence. The UK automotive sector must carefully balance growth, innovation, and efficiency to remain competitive and profitable in the future. So that's it from my side, and thank you for listening.